I'm Tom Selzer from Livewire Markets, and joining me today is Stephen Porto from Aries to discuss why investors should be considering infrastructure right now. Thanks for joining us, Stephen.
Thanks for having me.
Aries has described private infrastructure as a generational investment opportunity. Why is that, and how are you looking to make the most of it?
The reason we describe it that way is the growth we're seeing in the market. McKinsey just put out a recent study that between now and 2040, the expected expenditures or investment that are needed in infrastructure on a global basis is over $100 trillion. If you just focus on the US private infrastructure deal volume 7 years ago was around 160 billion. Last year it was over $415 billion, and it looks like 2025 is going to eclipse that. So we're seeing incredible demand for investment to build out new infrastructure that we need across the globe. Part of that is driven by replacing aging assets that have been there for decades, but it's more commonly driven by the growth and meeting increased demand, whether that be in the digital space, as our lives just get more and more digital and there's more demand for data needs and storage and so on. Our energy needs are growing, our transportation needs are growing, so we're really seeing that growth across all the different subsectors of infrastructure. And what we're focused on at Aries is finding ways to provide capital to build those assets, and so that we have long-term contracted cash flows and essential assets that are very hard to replicate. They've got high barriers to entry, and they provide cash flow stability to investors.
You've touched on the growth and demand there, but what do you think infrastructure offers as an investment, and how has it performed relative to other asset classes?
Yeah, I touched on some of them, and maybe the first thing to do is define what infrastructure is, or at least the way we think about it. For us, it has certain characteristics, some of which I already mentioned. So we're talking about very large assets. Think of a data center, a power plant, a midstream natural gas pipeline that transports natural gas from point A to point B, or a large transportation asset. They're CapEx heavy, so hundreds of millions of dollars, if not more, to build. There's high barriers to entry. You can't just go replace them in a 6-month or 1-year cycle. They take years to develop and years to construct, and they're income producing. So that's ultimately what we're after when we think about investing in infrastructure. And the way we're approaching it and the growth we see is finding unique investment opportunities where we can take our investors' capital, deploy it into them for a very long period of time, and it generates income and yield. It can be a downside protection. So you mentioned how it's performed in various cycles. The COVID, impact and the recession that followed, it emphasized the downside protection you can get from infrastructure assets. Other sectors, other asset classes really underperformed. We saw infrastructure's stability really shine through. So it's that yield, it's downside protection, it's also diversification. So whatever's happening in public markets, for example, or investment grade bonds or high yield bonds, that really has zero impact on whether your ownership in that long-term infrastructure asset is going to produce the cash flows that you think. So for those reasons, we think that there's really attractive attributes for investors. And one of the biggest things we're seeing changing in the market is on the investment side and origination and deal flow, it's that growth. It's also who are the investors that are being attracted to infrastructure. It has historically been dominated by institutions, large pension funds coming in directly, large closed-ended infrastructure funds or private equity funds in that structure. Now we're seeing an increased attention, and we think over time an increased allocation from individual investors, or broadly defined the high net worth investor set, because of those attractive attributes.
Yeah, and maybe on that point, obviously equities, gold have had really good performance in recent times. What's the sell here for infrastructure? I think you touched on the growth, the yield, the income, but is that what you're seeing from investors?
Yeah, we think that it's a great addition to a portfolio. If you think about how portfolio composition has changed over time, there's the traditional 60-40 portfolio, right? A pretty even mix of stocks and bonds. There's a growing understanding and interest in alternatives generally, and we think infrastructure should be part of that discussion. There's a place in every portfolio for publicly listed stocks, bonds, and debt or credit products, private equity, maybe some venture and real estate. we think infrastructure should be in that conversation. And we think that the increased understanding of its benefits, the increased allocation is going to help meet that $100 trillion need between now and 2040. We think that individual investors coming into the asset class is going to help fund this generational growth that we're seeing and generational opportunity. And
diving a bit deeper into the sector, you mentioned it before, data centers, renewable energy are two of the big opportunity sets right now. What's the outlook there, and do you have any examples of how Ares are trying to capitalize on that?
Yeah, I would say on data centers and digital, we're being very selective in the long-term equity ownership of those assets, in part because there's a lot of capital chasing it. It's very competitive. That has driven yields lower, of course. We are seeing sort of the indirect impacts of the digital growth being a more attractive entry point. So specifically power, that is renewables. It's also traditional natural gas-fired power generation, as well as other natural gas infrastructure. So midstream pipelines, liquefied natural gas. And so in those sectors, which are riding the same megatrend that we're seeing in growth in digital demand, we're seeing more attractive risk-adjusted returns. So I think that in any one time in my career, it can be pretty evident what is the right entry point on a different asset. Do you want to be the long-term owner and get the operating long-term cash flows of an asset? Or do you want to be the developer and builder of those assets, get it stabilized and cash flowing, take that higher risk, but then sell it down to that lower cost of capital long-term owner? Right now in digital, that's where I want to be. I actually want to be a developer and builder of those assets and then sell down to what is an immense amount of capital that's looking for that long-term equity ownership.
Any other thematics or emerging stories in infrastructure that investors might not be aware of now?
I think natural gas is quite interesting right now. Certainly, with political changes in the U.S. and it seems like more broadly globally, I think natural gas is having a bit of a moment right now, a bit of a resurgence. There's, I think, an acknowledgement growing that natural gas can actually be a tool to decarbonization. And generally, if you just took a natural gas plant and a coal plant, the natural gas plant would produce around half of the carbon emissions from a coal plant. So if we just did that across the world, if we could wave a wand and do that, we would more than beat our emission reduction targets. But it's not the total solution or a silver bullet, but certainly an increased acknowledgement of its benefits and how it can help stabilize our power grids. Now in the US, we are blessed with very deep, extensive reserves for natural gas. And so one of the things we're seeing is increased interest in exporting that natural gas globally, whether it be to Europe, to manage all of the issues going on with Russia and the imports of natural gas there, or to Asia as a lot of the countries and power grid operators try to burn less and less coal with natural gas in its place.
What is the strategic edge you think Ares is bringing?
There's three of them. So the first being the power of the Ares platform. Ares manages around $575 billion globally. We have thousands of investment professionals around the world. And myself and my team can leverage that from a origination deal flow standpoint, sharing best practices around what's going on in different markets, which helps us underwrite. And then, of course, enhancing assets once we've made the investment. So that's the first advantage. The second is what we're focusing on with our core strategy. We're just investing in operating cash flowing assets. So when we make an investment out of our core strategy, it's yielding from day one. We're not investing in the development of assets. We're not investing in the construction of assets. We're not investing in platforms or companies. There's lots of other infrastructure funds out there that are doing that. I think of that more like private equity infrastructure. When we set up the strategy, we saw such a great opportunity just in owning the assets themselves, which is why we can target what we think is a very attractive net 10% annual yield. And then lastly, third is the tax advantage nature that we've structured. So all of the distributions that come out of our core strategy are expected to be classified as return of capital. What that means for foreign investors is no US tax filing obligations, no US withholding tax, and there's also the potential based on where you live in the certain jurisdictions for deferred taxes at the local level as well. So I'm certainly experiencing that based on US tax rules And depending on where you are domiciled, where the investor is, there are potential for additional local benefits.
Do you mind just telling us a bit more about the type of assets you target?
Yeah, sure. So I just mentioned in the last question how we're just investing in operating cash flowing assets. We see really attractive risk-adjusted returns there. So just investing in operating cash flowing assets, and we're creating a diversified exposure to the different subsectors of infrastructure. So for us, that means power and electric infrastructure, natural gas infrastructure, digital infrastructure, as well as transportation. So we will own out of the strategy equity interests in a power plant, wind, solar, battery storage, natural gas fired generation, a natural gas pipeline or a liquefied natural gas facility, a data center, a long-haul fiber network. So those are the type of essential service, very high capex, hard to replicate, very long-lived assets that we're focusing on. And that's what in part leads to us being able to target, again, that net 10% annual distribution rate.
I think according to Ares data, US private infrastructure has grown at a 26% CAGR over the last 15 years.
Yep.
Do you see that continuing?
We do. So the stat I mentioned before is that US private infrastructure deal volume was $160 billion in 2018. Last year it was a little bit over $400 billion. Our data shows that 2026 will be in the $450 billion range. So continuing to see growth, and that's across all the different subsectors we focus on. And again, that's driven not only in replacing and upgrading existing infrastructure, but meeting the growing demand for infrastructure services, whether it be electricity and power or fuels like natural gas, or in the digital space as well, which is seeing incredible growth.
Thanks for joining us today, Stephen.
Great. Thanks for having me.
Thanks for tuning in. Make sure to check out our YouTube channel for more videos.